Detection of financial reporting quality issues. Introduction and presentation choices. Question 2. According to SEC regulations, when a company includes a non-GAAP financial measure in an earnings release that is filed with the SEC, it is required to A. Present the non-GAAP measure more prominently than the comparable GAAP measure. B. Omit any discussion of the most comparable GAAP measure to avoid confusion. C. Provide a reconciliation of the non-GAAP measure to the most directly comparable GAAP measure. Correct answer, C. SEC regulation. When companies have financial measures that aren't GAAP, like adjusted EBITDA or pro forma earnings, they need to match them up with the most similar GAAP measure, like net income or total revenue. This matching should include specific numbers that explain how the non-GAAP measure is different from the GAAP measure. For instance, if a company shares adjusted EPS, which doesn't include things like stock options, they should also show the GAAP EPS and explain what changes were made. It's important to make sure the GAAP figure is as noticeable as the non-GAAP figure. This way, companies can't trick investors by focusing too much on the non-GAAP numbers instead of the real results. Here are some important SEC guidelines for reporting non-GAAP measures. 1. Clearly explain how the non-GAAP measure is different from GAAP. 2. Ensure that GAAP measures aren't less important than their non-GAAP counterparts. 3. Avoid labeling non-GAAP measures as pro forma if they don't include regular expenses. 4. Provide a clear explanation of why non-GAAP metrics are helpful for understanding the company's performance. A. Incorrect. SEC prohibits companies from giving greater prominence to non-GAAP measures over GAAP equivalents. B. Incorrect. SEC mandates disclosure and reconciliation of non-GAAP measures to GAAP for informed investor decisions. Question 1. Which of the following financial metrics is most accurately classified as a non-GAAP measure? A. Gross profit. B. Free cash flow. C. Cost of goods sold. Thumbs up and subscribe this channel. Correct answer, B. Non-GAAP financial metrics aren't set by US GAAP or IFRS. They usually involve tweaking GAAP-friendly numbers to give us a clearer picture. Free cash flow, FCF, is a non-GAAP metric. FCF doesn't show up on income statements or balance sheets. It's a handy tool for checking how liquid and healthy a company is, but it's not a must-have according to accounting rules. The SEC considers FCF a non-GAAP measure, so companies need to explain how it compares to GAAP cash flows. A. Incorrect. Gross profit is a standard income statement line item under GAAP, calculated as revenue minus cost of goods sold (COGS). C. Incorrect. Cost of goods sold is a mandatory expense category under GAAP. Here are some common non-GAAP metrics. EBITDA, earnings before interest, taxes, depreciation, amortization. Adjusted EPS, earnings per share excluding one-time items. Pro forma earnings. Why companies use non-GAAP measures? To show what's really going on with their core operations. To take out things that don't happen often or aren't cash-based, like restructuring costs. To give analysts the kind of numbers they like to work with. To ensure transparency, companies need to align their non-GAAP figures with their GAAP counterparts. Also, it's important that non-GAAP metrics don't overshadow the main GAAP figures in their reports.